Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidated statement of cash flows using the direct method and a reconciliation for the cash flows from operating activities. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to be putting that into the blue area on the right-hand side, which will include our cost of goods sold or our cash flow worksheet, our cash flow statement, and then our reconciliation for the operating activities. Let's go to the information on the left. P purchased a percent of S on January 1st, 2000 X0, common stock 75%. So P's parent, S subsidiary, there's a controlling interest 75%, non-controlling interest 25%. Purchased at book value, so we have then no differential that we have to deal with. Fair value non-controlling interest 75%. The consolidated trial balance as of January 1st, 2000 X2 and December 31st, 2000 X2 are going to be on the right. Those will be these two trials. In essence, having the trial balance for the prior year or the end of the prior year or the beginning of the current year, basically a prior year after the closing process has happened. You can think of it as our post-closing trial balance. In other words, no income statement accounts, just the balance sheet accounts. And then the current trial balance, which includes the balance sheet accounts as well as the income statement accounts here for the current trial balance. That'll be in our worksheet. So then the dividends paid for P was $33,000 and S are $23,000 that were paid in the current year that we'll be doing the cash flow statement for. All right, so then we have our information on the right. This is going to be our trial balances. Again, you can kind of think of it as prior year, current year, the typical process, us thinking about the difference. This will be a typical worksheet. Once again, we do have a course that's just on the statement of cash flows. If you want to get into detail, I think this is an area where people don't really understand it as well as they could, even in public accounting. And if you really understand the cash flow statement and different ways to put it together and systematically do so, it can be useful because it helps you to kind of understand how everything's put together in general. So you might want to take a look at that. We're concentrating here, of course, on those things that are going to be different from the consolidated statements to the non-consolidated. So this January and December, these include the consolidated trial balances for those two periods. So these are the consolidated trial balances. First thing we'll do is take the difference. So I'm going to be here in G3 where I'm going to say this equals the 1135 minus the 815. There's the 32,000. Now it's green because I want to keep this kind of green, orange, whatever thing going. So what I'm going to do is now I made them blue so you can indicate that we're going to be using these items. Now let's highlight this whole area and make it black, right clicking on it, and let's make it black, so that we could see that a little bit more clearly. And now let's copy that and paste it down. We can't just copy and paste normal because you'll lose the coloring of it. So we're going to copy it. I'm going to highlight these cells, right click on the selected cells, paste it with a formula. Paste it 1, 2, 3. So we'll paste it with a formula, and there we have it. That should then put us back in balance. So we start with something, of course, in balance. We then have another thing in balance, and that ends with the difference being in balance here. So then we're going to go to our statement of cash flows. Now, of course, the thing that will change from the direct method and the indirect method is going to be the operating activities. So now we're thinking about the operating activities from a direct method, and then we'll do basically our reconciliation to the right. Now, it might be useful to actually do the reconciliation process first because this is basically, the indirect method. So let's actually do that first. And then we'll go back in and do the direct method because people might be more familiar with this method. Obviously, the direct method will be taking basically, you could think about kind of like the income statement accounts and you're changing it from an accrual basis to a cash basis. Whereas the indirect method, which we'll be basically doing here in our reconciliation, will be taking the net income and then that being the starting point and then reconciling, kind of going backwards to reconciling to the net cash provided by operating activities. Many times they actually, even though the direct method is more intuitive, I think more people understand it intuitively, and therefore I think it's worth doing. Many people will simply do the indirect method because a lot of times regulations will require the indirect method because even though it's more complex to understand, it results in a reconciliation between net income and the net cash provided in that reconciliation is considered or can be valuable. So then I'm going to go and hide these. I'm going to go from I to L, right click, let's hide these for now, and let's think about basically the operating section, indirect method, our reconciliation process. The bottom line number will be the same under the direct and indirect method. So typically we're going to have, starting out here with, I'm going to go ahead and paste the consolidated net income. So the consolidated net income is typically going to be the revenue and the expenses. We're not including the non-controlling interest here. So it's going to be this 87,250. So I'm going to do that with a formula up top. I'm going to say that this is going to be equal to, I'll put it in the outer column, equals the sum. And so we'll sum this up. And I'm going to say it's going to be sales down to other expenses, not including the income from non-controlling interest. And let's flip the sign. I want to make that a positive number, so I'm just going to put a negative in front of the S. Then we're going to have the adjustments for non-cash items. Once again, I would think about these adjustments as differences in the balance sheet accounts. So we're looking for the differences in the balance sheet accounts. For example, we have depreciation expense. So depreciation expense, I'm actually going to pick up from the balance sheet and try to mark off on the balance sheet side of things. So in other words, the change in the accumulated depreciation will be the depreciation expense unless there's some other sale or something that happened with the equipment. So I want to think about it that way. I'm going to say, well, this is going to be then, I'm going to say negative of this number. And I'm always going to be picking up negative of these numbers up here. And I'm going to say, all right, I found that difference here. It's also useful to note that this is basically the difference, and you can think of retained earnings or the equity section. In other words, if we were to add up the total difference in equity, all the blue accounts, including the income statement, right? This one doesn't have the income statement, but it's all rolled into retained earnings. So if I say, okay, here's the change in the equity, the balance sheet account, basically, once everything's closed out, once you have the post-closing trial balance or the balance sheet, there's going to be the change there. Now, if I want to reconcile basically to this number, then what's the difference going to be here? Then we know we have this non-controlling interest. I'm going to remove that. So I'm going to say negative of that 99750. We have the non-controlling interest up here, the 4,000, which I'm going to remove that, negative of that number. And then we have the dividends. So the dividends, I'm going to say negative of that number. And if I sum that up, then that'll get us to the 87,250. So we can think about this first number basically as a difference in the retained earnings. Note that if you take these two numbers here, let's go ahead and do that and say, I'm going to say this is going to be this plus that. And let's make that blue. That will basically equal the dividends that are going from P to the non-controlling interest. So in other words, the other way we can calculate that, or I can calculate it right here, this is going to be equal to the 23,000 times the 25%. So there we have that. So we'll deal with that basically in the financing section. And of course, we'll deal with these dividends in the financing section as well. So that'll be later. So let's go back up tops, and we're going to think, all right, next item is the amortization. So we have the amortization. So that's going to be in the patents. So the patents had amortization. I'm going to just call it amortization expense. Same kind of concept here. Amortization expense is on the income statement, but I would think about it as a change, in this case of the patents, the thing that's being amortized on the balance sheet. So I'm going to say negative of this number and then pick that up. Again, if something different happened, I would still pick up the change and then go back at some later point and figure out the difference, whatever else needs to be done there. So I'm going to say, let's make that yellow. All right, and then we're going to have the changes. Let's say the changes in the operating assets and liabilities, basically current asset and liabilities other than cash. So we're going to have the change in the accounts receivable. And notice I'm saying change in as like a general. You would want to say whether it increases or decreases once you've kind of finalized it. But if you say change in, you can do kind of a worksheet, and I'm just going to say everything's going to be negative of this 15,000, and that's going to be a negative here, bringing it down, and just that's the format of the worksheet. You can spend more time to think about why that is the case. If there's going to be, in this case, a increase in accounts receivable that results in a decrease in the statement of cash flows. If you want to go into more depth on why that is, you can go to our course on that. But for now, we're kind of just applying the rule here. And so if you set up the worksheet in this format, you'll get basically the rule. The other side, the liabilities, will do basically the opposite. Okay, and then we're going to have the inventory. So let's take the inventory, put that into place, and that's going to be negative of the 8,000. So there's the inventory. Let's go ahead and put a yellow mark next to that one. And then we're going to have the changes in the then we got the accounts payable. Accounts payable. Why aren't we doing the land or the building? Because those things are going to be in investing type of activities. So I'm going to pick up the accounts payable. Same thing here. I'm going to say negative of that number. And if that's just the way the worksheet works, you can think about it a little bit. 53,000 went up to 58,000. So that was actually an increase here, because these are two credits. This is an increase. And then we're going to record that on our statement as an increase in plus and minus format, increase. Okay, and then we're going to go, so they're basically doing the opposite as the assets. And then we're going to go to the changes in the wages. I could put a little yellow mark on that one. So we found a home for that one with the yellow mark. Won't let me do a yellow mark. And then wages, same principle, same procedure. So there's the 6,000 there. I'm going to put a yellow mark by that one. So if it lets me. Okay, so then we're going to have the total adjustments. So let's put in the adjustments here. And I'll indent that one more time maybe. And that's going to be the sum of this column. So those are our adjustments, and that's going to give us the net cash provided by operating activities. Net cash provided by operating out is going to be the outer column, which I'm just going to pick up the consolidated net income and the adjustments. So that's basically, the indirect method. So now let's do the direct method. I'm going to unhide some cells. So I'm going to go from G to M. We're going to get back to that 100,750. Right click on those selected cells and unhide by doing the direct method. So now we're basically, you can kind of think of us reconstructing basically this income statement using a kind of a cash flow method. And we got to reverse into that to do that. So we're going to say, all right, first line is going to be cash received from customers. And let's actually look at a little worksheet down here, which will help us out with that. If we're thinking about, and I won't spend a whole lot of time on this again, because you can go back to the cash flow statement. This isn't, different with regards to cash flow for this method or for one company versus a consolidation. But if we think down here, we're going to say, all right, the things that will be involved, if we're trying to convert this to basically sales from a cash method, we would pick up the sales item, and the other thing that would be involved is going to be the accounts receivable. So then if I was to take the difference between those two, we're picking up then that 477.50. Now you could spend more time on why we would go which way on these types of things. But again, not spend a whole lot of time there. We're going to then do that with a formula, and I'm going to say, let's make the formula, it's going to say negative of, and you could, well, let's just pick it up from here. Let's just say this equals this number. That'll be our calculation, and that way people can see where that is from if you're just using the Excel sheet. And that basically takes into consideration this account. Let's go ahead and make that like a color, some kind of color. Let's make that green now. And let's make this a little larger so we can easily, and then let's make this green. So we've done that. We've used those two accounts in our direct method. So now let's consider cash paid to suppliers. So we got cash paid to suppliers then. So then again, we can kind of break that down below here. We can break that down. So the cash paid to suppliers, we might consider then the cost of goods sold. So let's pick that cost of goods sold up and make that green. Let's go. The other expenses would be what we would consider cash being paid to suppliers typically. Let's pick that up in this calculation as well. And then the other side of things, on the balance sheet side of things, we might have inventory. So that change in inventory is going to be an item that needs to be picked up. So I'm going to pick that up. And then we have the accounts payable, the change in the accounts payable, because that's what we owe to the vendors. We need to pick that one up. So if we take those numbers and add them up, I'm putting a little green thing to say that we've included these. We're getting the 296,000. 296,000. I'm going to say that that will be equal to the 296. So we've considered these green items here. Then we got cash paid to employers. Let's do the same thing. Cash paid to employers. Cash paid to the employees is what I should say here. So when the employers are the ones paying the cash. So in any case, we're going to say then that, let's do some underlines here. We're going to be picking up then the wages expense is what we would expect to be the other account on the income statement with regards to that. Then if there's any payable with relation to wages, we would have to take that into consideration. Those are going to be those two, 60,000. So 60,000, we're going to say that's going to be equal to then the 60,000. And notice I should be putting, this one should actually be a negative number because this is going to be cash paid. So I'm going to say this is negative and this is cash paid. So this is going to be a negative. And then we're going to have cash paid for interest. So cash paid for the interest. And for that, we're going to be picking up the interest expense. So let's just go ahead and do that. I'm going to say negative of that 14. That'll be the interest expense. And that'll give us our net cash provided by the operating activities, which we hope will be 100,750. So let's go ahead and say, all right, I'm going to indent this one more time. Let's sum this up and see what we get. So we've got the 100,750. So that lines up here. That looks good. We've included interest expense. Let's go ahead and make that green. Notice the depreciation not included, right? Why isn't it included? Because that's a non-cash item. So when we do our reconciliation, we had to remove the depreciation expense. And the same is true with the amortization, which I made green, which shouldn't be green because the same thing is true there. I think I did the wrong one for the interest. So those are those items. That's going to be our reconciliation process. Also note, you could think about it this way. You know, these two are netting each other out. So we don't have that adds up to 0. So we don't have the balance sheet side of things green, and we didn't include the items down below which would basically, you know, net each other out. So you can consider that in the reconciliation process. Now we're going to have the cash from investing activities. So we're going to say that land, it looks like land went up. So we're going to assume that it's a purchase here. We're going to assume there was a purchase of land. And I'm just going to go through the same process we did before. When we were working over here, I'm going to say negative of the change. Negative of the change would be the cash going down. So it would be a reduction here on the cash. So I'm going to say that. Now, there might be some other things involved in that. I would first record the change, which we're going to say that's it, and then see what the transaction is related to that change, and then go put in the more detail related to it after you have already reconciled. And then we're going to do the same thing for the building and the equipment. Building and the equipment, I'm going to say negative of that 35,000. Same process. I'm going to assume that more building and equipment, more depreciable assets were purchased. Then I would want to go look at those purchases and see what they were, and see if there's more detail than just, you know, cash payment for it, like a loan or something like that. And also I should be putting purchase of land, purchase of building and equipment. Okay, now let's sum this up. We're going to sum up the outer column. So there we have that. So we've taken care of this one. So let's go ahead and make that green. And now we're going to go to the cash flows from financing activities. Cash flows from financing activities. Let's take a look at the change in the note payable, which we're going to assume was an increase to the note, or more financing taken out, more of a loan taken out because it went up. So again, you'd want to make the change here, reconcile, then go back in and consider if there's any more, detail that you need to include in there as well. So I'm going to then say the dividends paid to parent company shareholders. that was, we're going to say, an outflow of cash of the 33,000. So it's negative of 33. We're going back to our reconciliation between basically the equity section down here. So now we've picked up that 33, and we're missing basically this change that I've put down here now of the 9,750 and the 4, which is going to be the dividends paid to the non-controlling shareholders. And I'll pick that up from this number down here. So I'll make this blue. Oh, not that. Hold on a second. we'll make this one blue and see where that is coming from. Right? That is coming from the 25% of that 23,000. And so that is what I'll say we'll pick it up from here. So it's going to be a negative of this number, and that's picking up this change, right? This change is now being picked up over here as well. So we could see that. And then we have the net cash used in the financing activities, which is going to be the sum of these items. Then we have the increase in cash. So the net increase in the cash is going to be the sum of the outer columns, or the operating, investing, and financing activities. So we'll take the sum of these. And then we've got then the cash at the beginning of the year, and then the cash at the end of the year. Cash at the beginning of the year was equal to 81,500 according to our trial balance. Therefore, cash at the end of the year, we hope, is going to be that 113,500. And there it is, the 113,500 matching the 113,500 on the what would be the balance sheet for the consolidated balance sheet in the current time period.